cautious about. So we have an environment in which we've got strong inflows into domestic mutual funds. And they're quite encouraging in many ways because they're monthly inflows, which is definitely the right way to buy equities, as opposed to buying them when they're at the top, which often happens with retail money. We've also got a dynamic where the positioning in emerging market funds is still very underweight relative to global funds. So you've got a very nice technical position, but at the same time, you're buying markets on reasonably high valuations. So I tend to look at things based upon the MSCI indices for common comparison across markets. So India is about 18 times on a forward PE. That's about 0.9 standard deviations above its 10-year mean. And I do, in sort of talking to clients, get the general feedback that it's difficult to find things to buy. They know what the themes they want to play, the sectors, but the valuations they're paying, they're anxious about. Now, I don't think that situation is going to change for now. And if you think about the relative opportunities, we've got a very flush monetary system. Fixed deposit rates are much lower than they have been historically. Bond yields are behaving themselves, and the rupee is proving to be surprisingly strong relative to expectations. So I think we will maintain these premium valuations, but our view is that the market should probably go up with the earnings growth numbers. We're going to be getting the results for fiscal year 17. I think they'll be relatively pedestrian, single-digit, high single-digit growth. The question is, what do we achieve in fiscal 18? And I think that's where we've got some guests on from the real estate sector, from the banking sector, and these are the areas where we're going to need to see activity pick up, particularly in the banking sector when it comes to corporate loans, which have been quite disappointing. And then we've also had the distortion of the final quarter of last year, the calendar year, with demonetisation, and how does that come back? And it's a very interesting dynamic because, if you look at India for the first quarter in terms of stock market performance and some of the data points, it looks very strong, but remember we're comparing that to a weaker base in the final quarter of last calendar year. So it's a very interesting dynamic at the moment. I
take your point about loan growth. I mean, I was reading some reports which suggested that average loan growth now for banks has fallen to less than 5% post demonetization. So, that's a scary internal. But I'll come to that in a bit, Adrian. Good morning and thanks for being with us.
Thanks,
emerging markets after a long time have come out of a funk. This year, at least, they've started to perform, deliver some returns. Why do you think that is? And what would your view be between developed and emerging markets for the rest of the year?
So I with respect, describe my clients as growth tourists. So they sit in London, New York, Tokyo, and they buy emerging market equities for premium earnings per share growth. It's not really about GDP growth, etc. You've got to deliver premium earnings growth if you're an equity. And from 2011 to 2015, the EPS integer for EM fell. Developed markets were delivering premium EPS growth. They were actually delivering EPS growth, I should say. In 2016, that was the first year in 5 that emerging market equities delivered premium earnings per share growth. And for this year, again, we're delivering the same thing. And the positioning is extremely bearish by the global asset allocators in emerging markets because they had 5 years of underperformance. So the core fundamental of premium earnings per share growth is now in place. Now, the reasons for that are many, but if I was to sort of think of some key big reasons, in 2009 and 10, there was too much stimulus in the emerging world. And in 2011, we had an inflation problem, so we started to tighten just as all this new capacity is coming on stream. And so you get a collapse in profitability because there's a lack of pricing power. And then we should have exited that tightening cycle around 2013, but on the 22nd of May 13, the Fed published the tapering minutes. And that kept the tightening cycle going for some countries for longer, including India. The other overlay we had was a fall in commodity prices, which was very much an issue of too much supply rather than necessarily a lack of demand. And as commodity prices fell, the terms of trades for many of the emerging countries deteriorated and their currencies fell. So those were the sort of big factors. we're now turning around. And I think what's very interesting is just how cautious the corporate sector is across emerging markets. And that's because they've been through quite a protracted downturn. And we could get a dynamic that's similar to what we saw in the United States, where you've got good corporate profitability, rising ROEs, but perhaps the economists are commenting in a more negative way, saying that corporate capex is not picking up as we wanted. For us as providers of capital, that environment can be actually quite good if companies are cautious. Although ultimately, in the longer term, we do need people to believe in growth, and we do need corporates to invest.
Okay.